So if you are an active real estate investor, you know this feeling. I mean, this gut-wrenching feeling.
Oh, absolutely.
You've spotted the absolute perfect um, undervalued property. It's the one that has massive potential. But the seller wants to close in 10 days.
10 days, the
Yeah.
magic number.
Exactly. And you call your traditional lender, and they start talking about 45-day underwriting processes, credit checks, endless paperwork.
And in a competitive market, somewhere fast-paced like San Diego, that dream deal is just, it's gone.
It's gone. It just slips right through your fingers because you can't perform fast enough.
Right.
Okay, so let's unpack this. We've got our hands on some specialized documentation from a private lender, and our mission for this deep dive is to really understand the mechanics of what they call hard money loans. These are the alternative financing options designed specifically to inject speed and flexibility into these deals.
And that speed is everything. What's fascinating here is understanding why this whole system even exists. I mean, we're not talking about some fringe product.
No, not at all.
We're looking at a necessary countermeasure to how rigid traditional banking is. Banks are just inherently designed for consumer safety and slow risk mitigation.
Right.
Hard money lending exists to solve that one problem, bridging the gap between a fleeting property opportunity and instantly accessible capital. It lets investors bypass all that bank bureaucracy.
So let's get to the core. How do we define it? What is a hard money loan?
Fundamentally, it's any loan that is secured by a hard asset.
And that asset is almost always real estate, right? Commercial or residential.
Exactly, which makes it classic asset-based lending. And that one distinction, it just changes everything about the transaction.
I've heard it called a few different things. Private capital loan, private loan, or sometimes just a bridge loan.
All synonyms, yeah.
But the key insight for anyone listening is that shift to asset-based lending. The lender is looking primarily at the collateral, the property itself, not so much the borrower's credit score.
The value of the brick and mortar secures the debt. That's it. And this shift in risk calculus is the why behind the speed. If you think about the bigger picture, traditional lenders just have very little appetite for funding properties that are distressed, vacant, or non-owner occupied.
Especially if they need a ton of work.
The second an investment property needs a major rehab, banks often balk, and their approval timelines just stretch into months. This is why investors miss out.
And hard money is structured to deploy cash in, what, days?
Sometimes within days, yeah. Because the collateral itself mitigates so much of that risk for the lender.
This sounds great, but doesn't focusing only on the asset mean the borrower is taking on higher risk, or at least a higher cost? What's the trade-off?
That's the critical question. The trade-off is often higher interest rates and shorter terms. But the lender's risk mitigation is based on a conservative loan-to-value ratio, the LTV.
Okay, so what does that mean in practice?
They might only lend, say, 65 or 70% of the property's current value, or its projected after repair value.
Yeah, ARV.
Right. So that big equity cushion is what gives them the security to ignore 2 months of your tax returns and approve the loan that quickly. It's a structural difference that enables the speed.
So here's where the value proposition gets really tailored. Because these providers operate outside the traditional mortgage world, they can structure programs that fit specific investor strategies almost perfectly.
A whole toolkit.
Let's start with the one everyone knows, fix and flip loans.
The classic.
These are designed purely for rapid turnaround. You need quick funding to buy the distressed property, money for the renovation, and then the ability to sell fast. The priority isn't the interest rate.
No, it's the velocity of money. The faster you can turn that property, the higher your annualized return. And this loan is optimized for exactly that timeline.
And that often goes hand in hand with a bridge loan, right?
It does. While the fix and flip is about funding the whole rehab process, a bridge loan is purely about time. It's just short-term liquidity. It's designed to secure a property immediately, handle a quick transition, or maybe let you close while you're waiting for slower, cheaper, long-term bank financing to come through. It just holds the fort.
Right. Now moving into building a portfolio, we get to the DSCR loan, debt service coverage ratio. For anyone looking to scale their rental properties, this one is a game changer.
It's essential for serious landlords because qualification is based entirely on the property's income potential, not your personal W-2.
It completely sidesteps your personal income.
The lender looks at the projected rental cash flow and asks one simple question. Does that cash flow cover the new loan payment?
So can you give us a practical example? How does that calculation actually work? What does that ratio really mean?
Absolutely. The ratio is the property's net operating income divided by its total debt service. Lenders typically look for a ratio of 1.25x or higher,
1.25.
which means the projected rent needs to cover 125% of the loan payment. So if your total payment principal, interest, taxes, insurance is, say, $1,600 a month.
And the property needs to bring in at least $2,000 in rent.
Exactly. That meets the 1.25 ratio. It gives the lender a 25% safety buffer, and it dramatically simplifies the underwriting. They're analyzing the asset's performance, not your personal spending habits.
That is a huge shift in focus for scaling. Okay, so what if your goal is to create the asset from scratch?
Then you're looking at ground-up construction loans.
Right.
This covers the full life cycle of a project, from buying the land right through the final construction costs. It's flexible enough for a single-family home or even a small commercial development.
And for those scaling up even further, say, into apartment complexes.
You'd need a multifamily loan. Those are specifically designed to handle the complexity and size of financing duplexes, apartment buildings, and larger investments.
And finally, there's a really specific solution for the self-employed investor, which is becoming more and more common, the bank statement loan.
Ah, yes. Because so many entrepreneurs write off so many expenses, their tax returns often don't reflect their true cash flow.
Right. Their taxable income is low, but their cash flow is high.
Precisely. This loan addresses that paperwork problem directly. They qualify you based on the actual deposits in your bank statements, usually over 12 or 24 months. It's built for non-traditional income.
That's a pretty comprehensive toolkit.
Mm-hmm.
But let's get into the brass tacks of logistics, because this is where that speed promise is either proven or broken.
Mm-hmm.
First, let's revisit that speed comparison. We heard 14 days.
Mm-hmm.
How does that physically happen?
So what we found in the source documents is that the reported average time to receive funding is just 14 days.
14 days in a competitive bidding situation,
Yeah.
that is? That's basically like a cash offer.
It's transformative. It gives you a huge competitive advantage over buyers who are relying on those 45 to 60-day bank approvals.
And this speed has to rely on a lean documentation process. A bank might ask for years of tax returns, pay stubs, everything. What does this lender prioritize instead?
They prioritize what directly confirms the asset's value and the borrower's ability to service the debt. For a standard residential deal, the checklist is surprisingly lean.
Okay, what's on it?
You need the standard loan application, of course, your driver's license, and critically, 2 months of bank statements.
Just 2 months.
Just 2 months. They're looking at current cash flow patterns. Then you need entity documents, if it's in an LLC, and the appraisal. And notably, the appraisal is the only cost you pay up front, since it goes to a third party.
And I see there are 2 final documents that are specific to the type of deal.
Correct.
So if it's a DSCR rental loan, you need the lease agreements to prove income. If it's a fix and flip, you need the scope of work and rehab budget.
Right, to prove the project's viability. And
Yeah.
that's pretty much it for the core package. That streamlined checklist is what makes the 14-day turnaround possible.
They're not trying to understand your whole life story.
No, they're assessing the project and your current liquidity. This lean underwriting is the secret sauce to their speed.
Let's talk money. Hard money can imply higher costs, so what about upfront fees and any kind of penalties?
Good question. Regarding upfront costs, the documentation shows that there are no costs charged by the lender themselves before the close.
So just the appraisal.
Just that third-party appraisal. And as for prepayment penalties, which is a big concern, they are generally not applied for residential bridge, ground-up, and fix-and-flip deals.
Why are those specific deals exempt?
Because the lender's business model relies on a quick exit. They expect you to refinance or sell the asset pretty quickly, usually within 12 to 24 months.
So penalizing a quick payoff would work against their own model.
It would run completely counter to their business interest. Now, for longer-term loans, like a DSCR rental loan, penalties are more standard, but the source notes, they're often negotiable.
That's good to know. And what about the scope? What kind of properties and loan amounts are we talking about here?
This provider focuses mainly on residential assets, from 1 to 9 units. They cover ground-up, fix and flip, and rental projects. They'll consider 10-plus units, but it's case by case.
And the loan amounts.
For residential, the minimum is $200,000 with a maximum of $5 million, though they have higher limits for large-scale commercial stuff.
And finally, we have to talk about geography. This isn't a solution that's available everywhere in the country.
Right. Lending regulations create geographic limits. This particular lender operates in 42 states.
So who's left out?
If you're listening from North Dakota, South Dakota, Minnesota, Vermont, Louisiana, Utah, Alaska, or Nevada, this specific financing is currently unavailable from this provider.
That is a very important detail to keep in mind.
For sure.
So let's wrap up this deep dive by revisiting the core strategic advantage here. We've talked about the mechanics, but the real benefit seems to be about preserving opportunity.
That's it.
The major takeaway is that hard money provides an essential path for buying investment properties, especially ones that need work, where a traditional bank would either delay until the opportunity is gone.
Or just decline the application outright because they hate non-owner-occupied rehabs.
Right. So it buys you time, which is the most expensive commodity in a competitive real estate market.
And if we connect this to the bigger picture, it just underscores how inefficient the traditional system is for specialized investors. The market demands speed, flexibility, and different ways to qualify. And that demand has driven the hard money market into this sophisticated and I think necessary counter system. It's an essential tool if you're an aggressive investor looking to scale quickly.
Absolutely. This deep dive has really shown how hard money enables that speed, provides program flexibility for flips or construction, and offers qualification based on property income instead of just W-2.
And this all raises a really important question for you, the listener, to consider.
Go on.
Since we know the interest rate on a hard money loan is usually higher than a conventional loan, but those prepayment penalties are often waived for short-term deals, how do you mathematically calculate the specific cost of speed in your financial model?
That's a great point. You have to weigh the higher interest expense against the massive financial cost of missing out entirely on a great deal that sells in 2 weeks.
Exactly. It forces you to consider the true time value of money in a highly competitive market.
Something to mull over as you map out your next investment and calculate your opportunity costs. Thanks for diving deep with us. We'll catch you next time.